basic objectives of a company, and how do they decide what exactly to, what should be the direction of their policy, what do they want to achieve. So that is one part. So normally you would think that since the shareholders own the company and the shareholders are mostly interested in the creation of wealth, that means they want a good return, they want to increase their investment. That is, after all, the main reason why anybody invests. So what happens is, when they invest in a company, what should be their main objective? It's quite obvious that they would want to increase their investment. So the main objective will be to maximize wealth. So you understand, Harsh, what I'm saying? So basically, the company should work in a way in which the wealth creation by the company is maximized. Okay. So if this is the case, then what we have to understand today is what is the meaning of wealth maximization, and is wealth maximization possible? Is it actually possible to maximize wealth, or are there certain problems with that? That's why we say limitations. Are there certain problems? Now, in a very broad way, what is the meaning of wealth maximization? The ability of a company to increase the value of its stock for all the shareholders is referred to as wealth maximization. So it is a long-term goal, involves multiple external factors like sales, products, services, market share, etc. Mainly concerned with long-term growth of the company, and hence is concerned more about fetching the maximum chunk of the market share to attain a leadership position. Remember, when we were talking about competitive advantage, even then we were talking about how a company is most interested in attaining a leadership position. So here, what we have is this particular company, any company would like to be the market leader. When it is the market leader, it is able to, let's say, increase its profit margins, increase the amount of wealth that it actually creates. That is the purpose. Now, to understand the concept of wealth maximization, it becomes necessary to understand the concepts of present value, net present value, discounting, and opportunity cost. Are you familiar with these, Harsha?
Somewhat.
Somewhat. No problem. I'll try to, I'll approach this as if you are doing it for the first time, so that by the end of it, you'll be very clear about exactly where we want to go. So let's start with present value and discounting. Let's take these two things. So when we say value out here, now we are basically concerned with a monetary value. Just try to think of it this way. What is the value of money? What is its value today? What will be the value of the money in the future? So present value. So basically in finance, when you say present value, you're trying to understand, or the context is the value of 1 rupee. Why is this important? Because it brings into question one simple thing. A rupee today has more value than a rupee received in the future. You agree with this?
Yes.
So you may get 1 rupee, maybe one currency note, but the purchasing power could be different today and the purchasing power could be different tomorrow. And there is one more aspect. If I give you the money today, maybe you can use the money to earn more money. So if I give it to you in the future, you don't have that chance. So rupee received today can be invested. Its value will keep increasing. This is one basic point. Now, so the value of a rupee, if you say this, that a rupee received today can be invested and its value will keep increasing, then the corollary of that statement is that the value of a rupee received in the future is less than the value of a rupee received today. Now, the other aspect is inflation will also reduce the value of the rupee. But in a situation where there is no inflation, even there, the value of a rupee received today will be more than the value of a rupee received in the future, because if you get it today, you have a chance of investing it, and depending on the interest rate which is available in the market, you will be able to increase the value. Is this clear, Harsha?
Yes.
Okay. Now, assume that if you receive the rupee today, it will be possible for you to invest that rupee at 10%. Okay? Now, just try to follow me here. Suppose the date is 1/1/20. You receive, today is the first, in this first example, today is the 1st January 2020.
Today's date is 1st. Today's 1st January 2020.
Okay. Now I receive 1,000. So the value today is very clear. It's 1/1/20.
Yeah.
If I take this money and I invest it for 1 year, then I'll get 1,100 rupees at 10%. How am I getting it? 1,000 multiplied by 1.10. So I'm getting 1,100. So this 1,100 is the future value. The value of the rupee 1 year from 1/1/20 will be 1,100. Okay?
10% is the interest rate.
10% is the interest rate. Now let's come to another example. Today is 25th. I receive 1,000. Okay? Now, I received 25, 26, 23. I am going to receive this 1 year from today. I am going to receive 1,000 1 year from today. On 25/6/23, I will receive the money. So what is the value of that 1,000 today? To get that value, assuming that my interest rate is still 10%, I will take 1,000 and I will now divide by 1.10. So I'll get 909. So that means the present value of the sum of rupees 1,000 receivable on 25th June 2023 today is 909. Assuming that my interest rate is 10%. Now, when I do this, it also means, suppose I received 909 today, and suppose here, instead of saying 1/1/20, I received, let's say, 1,000, I write 909. Then 1 year later, if I multiply by 1.10, this 909 will become 1,000. Correct?
Yes.
So basically, what I'm doing is I am dividing the amount of money I will receive in the future by 1 plus the interest rate. But if I do this, I am getting the present value. So this is one concept you have to remember. Now, this process of dividing the principal amount, the inflow of what you will receive by 1.10, 1 plus interest rate basically, is called discounting. This is what is discounting. And this, what you obtain by discounting it, what you obtain by discounting a future cash flow is called the present value. And the process is discounting. Okay, so this is one. So present value of an amount receivable in the future is obtained by discounting. So the main lesson to draw here is that the value of money receivable in the future is less than the value of money today. Okay, Hardik is here. Very nice. Hardik, can you?
Yes, sir.
Good evening, Hardik.
Good evening, sir.
So I was just starting. I think we can just repeat this part. So today now we'll be doing.
Sir, I'm just traveling right now, so my camera is off. I listen all things.
Okay, you listen. I'll just repeat this quickly. So basically, what we are doing today is this concept of wealth maximization. Now, to understand, so what is the main, let's say, objective of a company, or what does the company do most of the time? What do you expect it to do? You expect it to maximize its wealth. Because the owners, the people who have invested in the company, what they are most interested in is, okay, Anjali is here, okay, very nice. Anjali, are you with us?
Yes, sir. Good evening, sir.
Good evening. So I'll just quickly, this is the first slide. I'll just quickly revise what I just did. Harsh, you will have to be a little patient. Sorry. So what we are doing today is wealth maximization. Now, wealth maximization, basically, when a company is formed, shareholders put money into it, what one expects the company to do is try to increase its wealth. That's the basic point. Now, to understand what wealth maximization is and how possible this is, we need to understand the concepts of present value, net present value, discounting, and opportunity cost. There are 4 things. These are all basic things in finance. So I'll try to present this to you in a very simple way. So the first thing here, Anjali, is that a rupee today has more value than a rupee received in the future. I think you can agree with this?
Yes.
Now, this is because a rupee received today can be invested. Its value will keep increasing as we go into the future. So the value of a rupee received in the future is less than the value of a rupee today. This is a simple thing. Now, this means that if you invest somewhere, and in that investment, if you begin to receive money in the future, what is the value of that future receivable? Now, to understand that, what I did was, I put it like this. Let's say that you receive 1,000 rupees. So first, forget about this part. I'll just look at this one below. Suppose you are going to receive 1,000 rupees on 25th June 2023. Now, as per this principle, the value of this 1,000 rupees today should be less. Because we said that the value of a rupee receivable in the future is less than the value of a rupee in hand. So, how do I find out what the value of this 1,000 is today on 25th June 2022? So, to find this out, we assume that the interest rate is 10% and we divide the amount we are going to receive by 1.10. 1 is the principal plus 0.10 the interest rate, and we get the figure of 909. So, assuming an interest rate of 10%, 1,000 rupees receivable on 25th June 2023, it has a value of 909 rupees today. If you reverse this, you can say that if you get 909 rupees today and you invest it at 10%, you will end up with 1,000 rupees 1 year from today. Is this basic concept clear, Anjali?
Yes, sir.
Okay. Now, let's look at the concept of net present value. So we understand present value. We're trying to understand net present value. And this concept comes up when a company invests in a project. When it invests, it needs to understand what amount of profit it is going to make over the period of over the life of the project. So every project has a life. Let's assume that this particular project has a life of 5 years and I invest 10 lakh rupees. And I also assume that you're going to receive 3 lakh rupees per year from this investment. Okay. Now, how much money will you receive in present value terms from the project? Now, if I just take it in simple terms, every year I'm going to receive 3 lakh rupees. 5 years I receive 3 lakhs. I end up with 15 lakhs. But the difference is that I am going to receive this at different points of time. The first 3 lakhs I receive 1 year from today. The second 3 lakhs I'll be receiving 2 years from today. The third 3 lakhs 3 years from today, and so on. So over 5 years, I'm going to receive this. And the principle is that money received in the future has a value which is less than money received today. And the other thing which follows is the further in the future you receive this, the lower the value of the money. So if I receive 3 lakhs 1 year from today, it is less than 3 lakhs which I received today. But the 3 lakhs which I received 2 years from today is even less than the 3 lakhs I received 1 year from today. So as I begin to receive money in the distant future, that value of that money is much less. This you intuitively understand this, not a problem, Harsh?
Yes, sir.
So now, if I assume this, how am I going to calculate what the present value is of all the 3 lakhs that I received? For the first year, it's very simple. I'll take 3 lakhs, I'll divide by 1.10, and I'll get a figure. But then I have the second year, I have the third year, fourth year, and fifth year. So how do I understand what is the present value of each of those inflows which I will receive in the future? Okay, now, to get this, what we should do is, we will have to discount each of the inflows by the rate of interest, taking into account the time of receipt. So let's take this point here. The sum of the discounted inflows less the initial investment is the NPV. We will understand this the moment we complete the example. Now, in this example, the initial investment is rupees 10 lakhs. Sum of the inflows after discounting is 11. How do I get that? Now, please just try to follow me here. The initial investment which I make, I have put a minus sign here. Any idea why I say minus?
We are investing the amount.
We are investing the money is going out. It's an outflow. Now, after that, every year I am receiving 3 lakhs. In year 1, I receive 3 lakhs. This is an inflow, income from the project. 3 lakhs in year 2, 3 in year 3, 3 lakhs in year 4, and 3 lakhs in year 5. Now, I am assuming that the rate of interest is 10%. So what I'm doing is, I take the 3 lakhs. So outflow of cash has been invested. These are the inflows. And how do I get this figure? I take 3 lakhs, I divide by 1.10. So I get 2,72,727. So the value of 3 lakhs receivable 1 year later is 2,72,000. Now I get 3 lakhs again in year 2 after 2 years. So what do I do this time? I take 1.1 and I square it. 1.1 squared is equal to 1.21. Now you take 3 lakhs, you divide by 1.21. What will you get? You will get 2,47,000. In year 3, you take 3 lakhs and you divide by 1.1 cubed to the power 3. So you're getting 2,25,000. Year 4, you're doing it by 1.1 to the power 4. So you're getting only 2 lakhs, 2,04,000. And the 3 lakhs which you receive in year 5, the present value of that you get by dividing by 1.1 to the power 5, which is 1.61. And you're getting 1,86,000. So you can see the present value of each of these inflows keeps going down with each passing year. With each passing year, the value is going further down. Now, if I total all these up, what I'm getting is, I'm getting 11 lakhs, 37,236. So now what happens is, I am calculating all the inflows here in terms of the value of money today. So since I have invested 10 lakhs today, I am looking at the value of each of my inflows over the next 5 years in terms of their value today. And the value which I have today is this. And if I add all this up, I get 11,37,000. I invested 10. I got back 11 after 5 years. So what is my net present value? It is this minus 10 lakhs. So my net present value is 1,37,236. So the normal rule is, if I have a positive net present value, I should invest. I should invest the money. Because I'm getting a positive return and I'm getting, even discounted at 10%, I'm getting a present value which is more than my investment. Do you understand this, Harsh? Clear?
More than investment is like more than the first year which we have.
You see, more than investment, what was your investment?
10.
10 lakhs. After 5 years, you have got back 11,37,000. In terms of present value, in terms of actual value, you've got back 15 lakhs. But in terms of present value, you are getting back 11,37,000. That means that you are getting something more than you invested. And you are assuming that the rate at, see, what shall I say, the opportunity cost rate is 10%. We'll just understand that opportunity cost thing a little better. Why did I use 10%? Because the assumption is, if I had not invested this 10 lakhs in this project and had taken this and invested in some other safer project, I would still have got a 10% return. So I am assuming that since I'm going to get a 10% return somewhere else, I discount all my inflows by 10% to see if I'm getting a positive figure or not. If I'm getting a negative figure here, what does it mean? Suppose this, instead of 137, I would have got 9 lakhs. What does that mean?
Present value is lesser than.
If the present value is lesser in terms, if I look at the rate of return, what would that mean? Right now it is 10%. If I am getting less, then that means the rate of return is less than 10%.
8 or
9. It will be 8 or 9. So if it is like that, then in that case, the question for the person deciding to invest or not is what? Should I invest and get a negative return? Or should I invest somewhere else where I'll get 10%? Because if I invest here, I'm getting less than 10. If I invest somewhere else, see, Harsh, suppose you don't even know whether it's 8 or 9. But you're getting a negative figure here. That means this figure out here, 1137, let's say this is like 9 lakhs. Let's say it's 937. That means I am getting 63,000 negative. One thing is clear, na? It may be 8, it may be 9, but it's less than 10. This I can very safely assume that it is less than 10. Now, what is the actual rate of return? To calculate that, I can do the calculation. It's called the internal rate of return, IRR. It doesn't matter. For the purpose of making an investment decision, all I need to know is, am I getting more than 10? Am I getting less than 10? So here I can see very clearly that I am getting more. I'm getting more than that. Therefore, it is okay to invest. You get the point? Anjali, were you following this?
Yes, sir.
You understood the logic here?
Not clearly, but I'm getting.
No, let's try again. Let's try again. See, you invested 10 lakhs in a project. And just tell me where you have a problem. You invested 10 lakhs in a project. Every year for the next 5 years, let's say the project has a life of 5 years. Every year for the next 5 years, you are going to get 3 lakh rupees. So you will get, like as in year 1, you'll get 3 lakh. After 2 years, you'll get another 3. After 3 years, another 3, and so on. 5th year, you'll get another 3. That's it. So you'll get a total of 15 lakhs. The question here is, should I make this investment or not? Now, somebody tells you, look, Anjali, why don't you invest somewhere else? We'll give you a 10% return. Invest somewhere else. We will give you a minimum 10% return. And we'll give it to you in year 1 itself. Forget about that. We'll give you a 10% return. Let's say that I just tell you this. What I need to know is the rate of return out here 10% or is it more or is it less? So what I do is, assuming 10%, we said that the value of money received in the future is less than the value of money which I have today. You agreed with this? Okay. So the value of 3 lakhs receivable 1 year from today is 2,72,000. How do I get that? 3 lakh divided by 1.1. What is 1.1? 10% is the rate of interest. 1 is the principal. So 1 plus 0.10, I get 1.10. 3 lakh divided by 1.10, I am getting 2,72,000. What is this 2,72,000? This is the value of the 3 lakhs, which I will receive 1 year from today. Now I get another 3 lakhs 2 years from today. Now, since I'm receiving it much later, its value should be less. How much less? What I do is I take this 1.1 and I square it. 1.1 multiplied by 1.1. What do I get? 1.21. So if I now divide 3 lakh by 1.21, I'm getting the present value of 3 lakhs, which is 2,47,000. Similarly, for year 3, you cube it, triple it. If you cube it, you are going to get 1.331. Divide 3 lakhs by that, you will get 2,25,000. Year 4, you go to the power 4. 3 lakhs divided by 1.46, you will get 2,04,000. Year 5, you will get 1,86,000. So basically, what does this tell you? The later the money is received, the less the value is. If that is the case, then all I need to do is I add up all these. Since these are now all in today's value, I get 11,37,000 against an investment of 10 lakhs. I end up with a positive figure of 1,37,000. So what this tells me is that it is okay to invest here because I am getting a return which is equivalent to the return I could have got in any other project. Do you understand it now? Okay. Note that the timing of the inflow is important for net present value. When do you get the inflow? So whenever we think in terms of net present value or present value, this word comes, inflow. Inflow is the money which is receivable in the future. Outflow is what you invested. Because when you invested it, it went out of your bank account. So it's an outflow. These inflows are coming into your bank account, inflows. So the later the inflows are received, the less the present value. So note how the present value of rupees 3 lakhs is less year after year. This is the one thing which you need to remember. The other thing, of course, is this process of dividing the inflow by the interest rate. This is known as discounting. So if you want to speak in the language of finance, you say that I discount the inflows to obtain the present value. Clear? Okay. So let's go to the next part. Now the next part is, now we try to understand wealth maximization. We understand this. The 10% that we had there, that was my opportunity cost, because the next best opportunity that I had was giving me a return of 10%. So I understand opportunity cost, I understand the term discounting, I understand present value, and I understand net present value. Now, given all that, I now try to understand wealth maximization. So shareholder wealth maximization, or SWM, means to maximize the net present value of a course of action for shareholders. Maximize the net present value of a course of action for shareholders. What do you think this course of action here means?
Period of time.
Yes, Harsh?
In a period of time.
No, not in a period of time. See, course of action basically means that, let's say that you are the CEO of a company. Now you decide to invest in a particular project. That is your course of action. You have decided to act in a particular way. Course of action. Getting it? So if I invest in a particular project, will I maximize the net present value? Will I get the highest return? This is what shareholder wealth maximization means. See, when I invest in a company, I put money in a company, the company does, undertake certain activities. It decides to, let's say, produce plastic buckets. Well, that is a project. So if it begins to produce plastic buckets, will they get the highest return possible? Will they get something more than their investment? Will they get something more than some alternative investment? So my course of action is to produce these plastic buckets. I am saying that the profits I will get from this project will be higher than the profits I would get in any other project. How do I say this? I say this on the basis of that exercise that we just saw. I project my inflows over the course of the time these buckets will be made and the sales that I will get. So lots of projections are there. And at the end of it all, I say that, yes, I will be getting something which is a net present value, which is positive. Okay, so the course of action should result in a positive net present value. So wealth is maximized if the NPV criterion is followed. If I follow this, I will naturally maximize my wealth, because I will always be investing in projects which are better than any other project. So if the best project is 10%, I will try to invest in something which will get me a little more than 10.
Excuse me, sir.
Huh.
I still didn't get it. What is course of action?
Course of action is the decision that you take, Anjali, in which project to invest. See, you invest in a company. Let's say that you are the owner of a company and I am the manager. I am the CEO of the company. Now you tell me, Ankar Rao, I'm not sure. So let's say that you are the CEO I am the CEO of a company. It's your money, Anjali. And you are expecting me to maximize your investment. Now, what do? I decide to invest in the manufacture of plastic buckets. Just an example. If I do this, then this is the course of action that I have chosen. This is how I have decided to invest the money which you gave me. Is it clear now? Okay. Now, so the idea is that once I have invested the money, I should end up with a return which is higher than the other possible returns that I could have got. I could have invested in plastics. I could have invested in, let's say, making yoga mats. I could have invested in making, let's say, textiles. I chose buckets because I felt that the profit margin was the highest here and I would get the most. And then I projected my inflows in the coming years. I discounted them by the best rate possible, and then by my opportunity cost. And whatever I receive, if that figure is positive, I know that I have made an investment which is better than other possible investments. That's all that you have to remember. So, if an investment is made today, how long will it take to commence operations, sell goods, and earn revenue? These are other factors. Suppose you invest, you set up a factory. You will buy land, you will construct the building, you will put in the machines, you will buy raw material, you will gradually begin processing the raw material into finished goods. And finally, when you get your finished goods, you will sell them. So from the time you actually began construction of the factory till the time which you begin to receive money from the sales of finished goods, that is the time in the future. So how long will that time be? Will it be 1 year, 2 years? Because you will be receiving your first inflows only after the factory is set up, only after the finished goods are produced. And that is going to happen sometime in the future. So when that happens, at that point of time, whatever amount you're projecting you'll sell, suppose you're projecting that I'll sell 10 lakhs. What will be the value of that 10 lakhs today? To understand that, you will discount that 10 lakhs by the opportunity cost, whatever it is. If it's 8%, 9%, 10%, whatever it is you discount, you will know what is the present value of that particular sales figure which you are projecting in the future. Is this clear? Harsha, are you getting this?
Yes, sir.
See, the basic point is, if you invest in a project today, let's say it's a manufacturing project, it is going to take some time for you to reach the stage where you will be actually able to produce the goods and sell them. Because you have to produce the goods, you have to make your factory, put in the machines, you begin, hire people, begin the entire operational work, get your finished goods. And only after that, once you have the finished goods, you'll be able to sell. And once you sell, you'll get money. Even there, that problem is there that you might sell on credit and people might give it to you later. So finally, you will have to make a projection. Look, how long is it going to take for me to actually get my goods produced? And then how long will it take to sell these goods? And how long will it take to receive the money? Whatever is the figure you have, let's say you say that it's going to take 2 years. After 2 years, every year you're going to continue selling. Then you will have to make a projection about how much sales you're going to actually have. How much will you sell? See, it's not an easy thing. Getting into the business of producing goods, you have to forecast. How customers, you will have to find customers for your products. You will have to sell them. So you will have to start with some projection. And this projection that you have is based on the timing. When are you going to actually complete everything? When are you going to be in a position to sell the goods? Okay. So the longer it takes, the less the present value, considering the time factor. Remember, when we, in the last example, what did we see? That 3 lakhs receivable after 1 year was equal to 2,72,000. for 3 lakhs receivable after 5 years was how much? 1,86,000. So it all depends on what you are expecting to happen. If you expect that things are going to be in a particular way, you're going to finish everything in 2 years, you're going to get so much of money after 2 years, you will arrive at a particular figure. If you feel that the sales are going to be much more, but the time is also going to be much more, then you will arrive at a different figure. But you will have to make projections, and on the basis of that projection, you will have to arrive at some figure. And you'll have to see whether it gives you a positive NPV or not. Lokesh is here. Lokesh, are you with us?
I'm here, sir. I'm sorry for the late.
No problem, no problem. It won't be possible for me to, revise. Like basically,
Okay.
I'll tell you, for you, you will probably know this. I was trying to explain wealth maximization. And to explain wealth maximization, what I did was, I began by explaining the concepts of present value, discounting, net present value, and opportunity cost. Okay.
Okay.
So I've just finished that, and then
Okay.
I'm coming to this point.
Okay.
Where I say that wealth maximization means to maximize the net present value of any decision taken by the CEO for shareholders.
No.
The decision I'm talking about, the course of action, refers to the investment decision. Where will he invest the money? What is he expecting to get? What will be the present value of the inflows that this person gets? Okay. Now, the time taken should be discounted by the opportunity cost of capital of the shareholder. So if the inflows are receivable after 2 years, I will divide the amount of inflow by my opportunity cost. So let me just show you the previous slide so that it will be a little easier for you to understand. So this was my slide location. I made an investment of 10 lakhs. In year 1, I received 3 lakhs. Year 2, 3, year 3, 3, year 4, 3, year 5, 3.
Okay.
I assume that my opportunity cost is 10%. If I had invested this money somewhere else, I would have got a return of 10%. So I'm using 10% as the discounting rate. So what is the present value of 3 lakhs, which is receivable 1 year from today? It has to be less. So 3 lakhs divided by 1.1 gives me 2,72,000.
This is IRR, sir. Internal rate.
So IRR will be, you can calculate the IRR based on this.
Okay.
So basically, all I'm calculating right now is, I'm just calculating the present value of the return for each year.
Okay.
And if I add the present value of all the returns, I get 11,37,000. I had invested 10. So I end up with an NPV of 1,37,000. This is positive. And therefore, I say that I can make my investment. So basically, what I'm saying is that for wealth maximization to happen, any course of action that I take should result in a positive NPV. Because if I'm getting a negative NPV, that basically means that my decision or my course of action was not the best one. There were better ways of investing my money, which I did not do. Then, so from there, we come to this point. The course of action should result in a positive NPV. Wealth is maximized if I'll correct this. This is if the NPV criterion is followed. So if I always use NPV as a basis for making my decision, and I always try to invest in the project which gives me the highest return, I will end up getting a positive NPV. That means I will get the best return possible. So when I make my projections, I have to consider how long it will take me to begin to earn money. I'm starting the actual construction of the factory today. I will complete the construction. I will put in the machines. I'll do everything possible, hire workers, do my marketing, get the finished goods, sell it, and then I'll begin to get some money. So I have to project this. When will I actually get my inflows? And once I get my inflows, I discount it by the opportunity cost, and then I begin to understand whether I am getting a positive NPV or not. And if I am, then I can say that, yes, I have maximized the wealth of my shareholders by taking this particular decision or this course of action. Okay, then if that is clear, let's look at another thing. Now, we say the wealth created by the company is reflected in the market value of the shares of the company. Can somebody try to just explain this? See, what is the value of a company? Normally, what you do is, suppose you start a company and you give 1 lakh shares, and each share, let's say, has a market value of 100 rupees. After, then what is the value of your company? 1 lakh shares multiplied by 100 rupees per share. So 100 lakhs, 1 crore. So the value of your company is 1 crore. Now, if I am going to create wealth, then it should reflect in my share price. So if the share price goes up from 100 rupees to 200, then that means that the value of my company has also increased from 1 crore to 2 crores. 1 lakh into 100 rupees was 1 crore. 1 lakh multiplied by 200 rupees per share is 2 crore. So if wealth, how do I know wealth has increased? One simple index is the value of the market share increasing? Is the market price increasing or not of my share? Anjali, are you getting this? See, whenever the stock market, if you look at the headlines, if the stock market does badly, that means the prices of shares fall. One of the headlines is billions of rupees of investor wealth eroded because of fall in share prices, stock prices. You see, every month, once at least in the last, the stock markets have been showing a slightly downward trend recently. So share prices have been going down. So this headline is always there, bloodbath on Dalal Street. You may have seen, headlines like this. Or shareholder wealth wiped out. Or they might take one particular, big shareholder like Warren Buffett or Rakesh Jhunjhunwala or someone, and they'll say that his wealth has suddenly come down by 5,000 crores. What are they actually trying to say? They are saying that the share price has come down. If the share price has come down, the value of the shares that you own will also come down. So let's say, Harsha, you have 100 shares of Tata Motors, and each Tata Motors shares is 1,000 rupees. What is the value of your shares? 100 into 1,000, 1 lakh rupees. Correct. Now let's say Tata Motors does fantastically well, and the share price goes up to 2,000 rupees per share. What is the value of your shares now? 100 into 2,000. So it's 2 lakhs. So if it's 2 lakhs, that means from 1 lakh, you reach 2 lakhs, wealth has been created. This is the point.
Yes, sir.
So wealth created by a company. So Tata Motors did very well. Its, let's say, performance was excellent. The market appreciated that. And as a result of that, more people wanted to buy Tata Motors shares. So it's a demand and supply thing. When more people want to buy the share, less people want to sell. The price will rise.
Prices.
So when the price rose, the value of the share price rose. Therefore, the value of the company also increased. So at any given point of time, the company has a certain number of shares in the market. What is the market value of the company? The number of shares in the market multiplied by the market price of each share. Simple maths, no issues at all. If I perform well, the market appreciates that and they demand my shares. They want to buy my shares. Whenever a large number of people want to buy my shares, the share price will go up. Demand and supply, the simple the equation there. More demand, less supply, price is going to go up. That is what happens. And if the price goes up, the value of the company also goes up. Now, the market value of the shares is based on the perception of the shareholders of the quality of the firm's financial decisions. So if the shareholders feel that the management is making the proper financial decisions, how do they know this? They know this because they feel that the actions taken by the management are correct. They are in projects which will give it good profit. Then there is a demand for the shares. So if shareholders are satisfied, they will not sell their shares. They may want to buy even more shares because they feel that I can increase my wealth even more by investing in the company. Apart from them, other investors will also seek to buy the shares. See, if Tata Motors goes from 1,000 to 2,000 in 1 year, what is going to happen is lots of people who are looking at the results will say that Tata Motors is doing so well. Let me buy shares of Tata Motors. And when they do that, the prices of the shares will further rise. So basically, the share price is linked to the performance. The performance is linked to the decision or the course of action taken by the CEO. So it's a chain. To maximize wealth, I take certain courses of action or I take certain decisions. If the decisions are correct, I make a good profit. If I make a good profit, the perception of the market is positive. More people want to buy my shares. Therefore, my share prices go up. Now, as share prices go up, you find that the market value of my company has gone up. So market price is a very good performance indicator. Okay. Market price is a very good performance indicator. It is a way of understanding how proper were the decisions taken by the management of the company. If it is appreciated by the market, it will reflect in the share price. Anybody, any question here? Harsh, clear? Anjali? Getting this? Do you invest in the stock market?
Yes, sir.
Lokesh, yes. Harsha?
Yes, sir. Now everything is in loss.
Okay. This is a phase. And Anjali? Not so far.
Sir, not so far, but I'm looking for.
Looking forward. So when we get to our financial planning part, we'll be looking at that in more detail. Maybe we can, motivate you to keep this in mind as an investment in the future. No problem. Okay. So now we come to this very simple chart here. What is the whole, this, an overview of financial management. So how does it work? Financial management is basically, the aim is to maximize shareholder value. How do you maximize shareholder value? You do it by taking financial decisions. The financial decisions that you take are basically four kinds. There are investment decisions, liquidity management, financial decisions, where to borrow, where to invest, that sort of decision, and dividend decisions. How much money to give as a dividend, how much money to retain in the company and reinvest in assets. So liquidity management is something we will understand when we get to our financial, understanding financial statements and working capital and all. We'll understand this liquidity management better in that case. Investment decision is what we were discussing a little while ago when we talked about NPV.
NPV.
That is investment. Liquidity management simply means, do I have enough working capital to manage my production? So I have invested in the production of a particular product. There are day-to-day expenses involved, the purchase of raw material, the salaries of my employees, the overhead costs, the insurance costs, logistic costs. So many costs are there. And these involve immediate payment of money. So I need a certain amount of liquidity. So in addition to the amount I actually invest in the infrastructure, I require an additional amount of money to manage the company on a day-to-day basis. This liquidity management basically is considering that. And the financial decisions are, where am I getting the money to do these things? Where am I getting the money? Am I borrowing it from banks? Am I getting it from an issue of debt? Am I getting it only from equity? Am I putting my own money in? How is it coming? And the final decision is dividend decision. I make a profit. I have an option. Once I make a profit, I have an option. One option is take the profit, distribute it among the shareholders, give it to them as dividends. Second option, give part of the profit as dividend, take part of the profit and reinvest it in the company. Try to buy a new machine, try to expand your operation somewhere. What is the idea? If I make that investment, I am going to get a higher return in the future. So I sacrifice my dividend today in the hope of earning more money in the days to come. So basically, dividend decision, investment decision. If I take a dividend decision and I decide to give everything to the shareholders, then I will not be reinvesting. But I might say that the profits that I have made, let me put it back into the business here. More money, produce more goods, make more sales, and earn more profits in the future. So if I do this, these are the financial decisions that I am taking. On the basis of this, if the market feels that I have taken the right decisions, my market price goes up, so the shareholder value is maximized. What we were discussing in the last slide. And there is a framework of return and risk involved. That means whatever return I am going to get, that NPV which we spoke about, where we talked about a certain rate of return, that return which I am going to get is directly related to the risk that I am willing to take. The rule is, if I take a higher risk, I can get a higher return, but I can also lose a lot. If I take a lower risk, I will get a lower return, but the chances of getting that lower return are high because the risk is less. So there is a trade-off between return and risk. If I want a higher return, it comes with a higher risk. This is the point to remember here. There is a trade-off. I should be willing to accept a higher risk if I want to go for a higher return. So the whole, the big challenge for the CEO is that he can invest in projects where the risk is acceptable and manage to get a decent return. for the shareholders. Because if he goes for a very risky sort of thing, it may result in the capital which he invested, being wasted. And as a result of that, it will not result in maximization of shareholder value. It will be seen by the market as a poor financial decision. And probably the share prices will go down. And it may result in an actual decline in the value of the company. Everybody with me?
Yes, sir.
Then let's move to the next part. So the risk return trade-off. So what happens here? CEO takes investment decisions considering the overall risk. So no matter what business decision you decide, whatever you decide to do, that course of action which I said, there will always be a risk. So it's a simple thing. Because there is no certainty. If there was certainty, then everybody would be doing it. So next, there is always a trade-off between risk and return. There is no such thing as a high return at a low risk. That will not happen. Then, higher the risk, higher the return, and vice versa. Then the CEO walks a fine line. He is walking on a very, very tight rope. If he is very conservative, that means he doesn't want to take risk. He makes a lower return. And if he is adventurous, he may lose the investment. If he decides to take a high risk, he goes for an adventure, takes a high risk, believing that this high risk will result in a higher return. But if things go bad, COVID comes, suddenly the market disappears. There's nobody to buy your goods. And you've already gone ahead and produced and invested so much and produced so much goods. Suddenly you find there are no takers for your goods. There's no one there who will actually buy your goods. What will happen? You will end up with a huge loss. And instead of maximization, you would have actually reduced the wealth of your investors. So it's a very tricky thing which he does.
Sir, can you tell me exact meaning of trade-off?
Yes, Lokesh?
Meaning of trade-off. Is it a trade-off means
Trade-off
opposite?
trade-off basically,
Clash,
if you have one thing, you sacrifice something else. So, trade-off basically means if I want, let's say in this particular, when I say risk return trade-off, I am saying if I want a high return, I am sacrificing low risk. I cannot get both.
Okay.
Okay.
Yes, sir. Yes.
That is the basic point. If I want a high return, I am sacrificing the low risk. If I want a low risk, I am sacrificing high return. So you have to choose. Which one do you want? See, it's very simple. You can invest in a bank deposit. You have almost zero risk. But what is the return you are getting? 5 to 6%.
Yes.
So you are sacrificing return for a low risk. You are accepting a low risk, sacrificing a high return. Now, in the stock market, you can get an excellent return, but the risk is very high. So in that particular case, what you're doing is you are basically sacrificing the risk part, the low risk part, to get a high return. You have to sacrifice something. Sacrifice peace of mind, get a high return. Get peace of mind, get a low risk. You won't get both. So trade-off basically means either or. Choose.
Okay.
Choose which one you want.
Okay.
Now, the CEO has this problem. He will have many competing projects before him. Should I do this? Should I do that? Should I produce the nano? At one point of time, this would have been, something which Ratan Tata would have had to decide. He decides it's worth taking the risk. Later on, it turns out to be a bad decision. Too bad for him. The trade-off was very clear. You are going to produce a car, a very small car, entirely made in India at a very low cost for the first time in India. There is a huge risk. But if he had succeeded and Nano had replaced Maruti, then the returns would have been fantastic. So basically, what he did was he decided to take a risk there. He chased a high return and he gave up peace of mind. He gave up the safety of a low risk investment. Low risk investment was what? Continue making trucks. You already have a market, expand that, stay there. But then there you're not going to make the sort of profit you could have made in the Nano. So that is the point. Now here I've tried to quantify it. It introduces two new concepts, the risk-free rate and standard deviation. I think it will become too mathematical if I try to explain this to you now. But what you can understand is something like this. Suppose the risk-free rate is 3%. That means there is a chance for you to invest somewhere, let's say in a government bond, and you will get a 3% return. There is no risk, zero risk. You will get it. Now, you invest in a project, you calculate that you can get a 13% return. You calculate that you can get a 13% return. Now, if I want to find out what is the risk-adjusted return, suppose I were to take this risk and reduce this risk to a figure, give this risk a certain percentage figure, then how much will this come down by? 13% is my expected return. There is a risk. So the formula is I take 13 and I divide by 3, I minus 3, and I divide by a standard deviation of 1, I'm getting 10%. That means the expected return is 13, but the risk-adjusted return is 10. What that basically means is there is a chance that I will end up with a 10% return. How is this 10% coming? Based on the return given by similar investments in the past. Based on the return given by similar investments in the past, it turns out that whereas some investments give you a 13% return, some may give you a much lower return. It deviates. If the average return, suppose I take 5 similar projects like this. One may have earned 13, one may have earned 12, one may have earned 15, one may have earned 8. It can be different. So you can take all these different returns, get the average rate, and then you can see how much deviation happens each time. Do I stay near the average or do I move this way or that way? Do I go higher than the average, lower than the average? Look, if this is getting too complicated, now don't worry about this. Just think of it like this. I want to invest somewhere I'm expecting 13%. Taking into account the risk factor, I am likely to get only 10%. There is another project where the expected return is even higher, 15%. But taking into account the risk factor, I am likely to get only 6%. Now, if I take these two as my endpoints, 13 and 10, 15 and 6. Now it's for me to decide, do I want to take this higher risk? If I take the higher risk, I may end up getting only a 6% return. But if things go well for me, I'll end up with 15%. Or I try to get 13. If things go really bad, I'll still get 10. So there appears to be a lower risk here. So should I go for this? Should I go for this? So let's say that Tata Trucks is here. Tata electric vehicles are here. I have a choice. Which should I invest in? Should I go for this? Should I go for this? what is the criteria for taking a decision? I want to maximize the wealth of my shareholders. As a CEO, I need to decide which of these decisions to take. If I'm very conservative, I will say, okay, let me stay with 30. At least I'll make 10. But if I'm very, like adventurous, I'll say, no, let's try for a 15% return. I am willing to accept that I may end up with only 6. Am I getting this point across?
Yes, sir.
So you may not, like the figures, don't try to understand the figures right now. I can explain this to you, but it will take at least 40 minutes to 1 hour before you'll be absolutely clear about what has happened. What you need to understand is deviation. What is the meaning of the word deviation? Deviation is a variance, something which varies from the average. What are my chances of getting 13? I may get 13, but in the past, it has been found that the return is not 13. It has sometimes been less. It has sometimes been more. What is the deviation from the average? It is 1. 1 standard deviation. It's a little difficult to, understand it that way. Basically, this is a way of just understanding or quantifying the risk. Okay, if you're still not confident, just remember this point. If I expect a higher return, the chances of getting a much lower return are very high.
Okay.
If I expect a smaller return, the chances of getting a lower return are less. If I try for 13, according to the maths, I will not get to 6. I should make at least 10. So basically, my risk is between 13 and 10. If I'm willing to accept this rate of return, I can invest. If I go for 15, there is a chance I might get to 6 because the risks are high. Anjali, are you making sense of this?
Yes, sir.
Broadly, you understand that if you aim high, if you aim for 15, you may actually end up with 6. But if you go for a more conservative project, aim for 13, then according to the past performance, you will at worst reach 10. That's what the figures show. So you call this the risk-adjusted return. This one. And this is the expected return, what you're hoping to get. So why do I do all this? It is easy for me to now decide what to do. I have all the figures in front of me. I have quantified everything. By quantifying the figures, I have made it easy for myself to take a decision. This is the whole idea. Now, project A has a lower return, but the risk-adjusted return is actually higher than project B. See, project A has a lower return than B, but the risk-adjusted return is actually higher than this, than 6. Project B has a higher return, but the risk-adjusted return is actually lower than project A. Sorry. So basically, the CEO has these two. Why I did this was, I just wanted you to understand that the CEO of a company has these choices to make. He has to decide, do I go for a high-risk project? Do I go for a low-risk project? If I go for too low, I may end up getting a very low return. Then wealth is not maximized. If I go for too high, then I'll end up with a high risk. If things don't go the way I projected, then I will actually end up with reducing the wealth instead of increasing it. This is the basic logic here. So it's a very tough decision which the guy has. Now, we come to something which is not mathematical, easy to understand. It's called the agency problem. So all of you are aware of the concept of a principal and an agent. What is the principal agent concept? Anyone? Suppose I am the owner of, let's say that I am a banker. Okay. I am a private banker, money lender. I give Lokesh 1 lakh rupees. Now, I don't have the time to follow up with Lokesh and keep getting my repayments of that money. Let's say that Lokesh is expected to return this money to me in 1 year. Lokesh has to give me 1 lakh plus interest, let's say 1,15,000 after 1 year. Now, what I do is I appoint Harsh as my agent. What is Harsh doing? He will act on my behalf. He will go to Lokesh. Lokesh will say, who are you? Harsh says, look, I am representing Sanjay sir. He gave you 1 lakh. You are expected to pay him 1,15,000 after 1 year. 1 year has passed. You have not paid. I have come to you. I am acting on behalf of Sanjay sir. Now, as an agent, what is Harsh expected to do? He is expected to protect my interests. That means he should try to get that 1,15,000 from Lokesh and give that money to me, in return for which I will pay Harsh. I'll give him a commission for this. So the relation between me and Harsha is what? I am the principal because it was my money, my transaction. Harsha is the agent. The basic point here is the agent is supposed to act in what? In the benefit, for the benefit of the principal. Any agent. So let's say that you give a power of attorney to someone. As per the power of attorney, that person is your agent. You give him, let's say that you want to register some land. You cannot be there present at the registry office. You give someone a power of attorney, and this someone goes on your behalf to the registry office and signs on your behalf to sell the land. You have given him the power to sign on your behalf. He is your agent. You are the principal. Now, in a large company, there is also this thing is happening. The persons who invested the money are the principals. The shareholders or the owners of the company are the principal. And who is the agent? The guys who are running the company. So the management staff, the CEO and the senior officers and all that, they are the agents of the owners. Now, shareholders own the company, managers run the company. Everybody clear about agent?
Yes, sir.
Now, the management is an agent of the shareholders and should run the company in the interest of the shareholders. Because remember, the whole theory in that agent principle thing is that the agent is supposed to act in a manner which is beneficial to the shareholder. That is what the agent is supposed to do. In a manner which is beneficial to the principal. In this case, the principal is the shareholder. So the management of the company should take all decisions in a way which is as per the expectations of the owners of the company. Who are the owners? The shareholders. Now, the owner is interested in maximizing their wealth. Anybody who started a company, one of the main points or one of the main things which he had in mind when he started the company was to increase wealth. So the management of the company should be taking decisions to increase the wealth. But the manager may be interested in their personal salaries, in their own power games, in their perquisites, big bungalows, big cars, big bonuses. If they do that, then what will happen is that the wealth that is created will be his personal wealth. And the shareholders will actually be getting less than they could have got. Is this clear? See, who takes the decisions in the company?
Managers, management,
The management. Who owns the company?
shareholders. Shareholders.
Manager is expected to work for the owner, but
And
can they actually make the manager do exactly what they want?
no, sir.
They can't do that. No?
Yes, they
Because
can't.
the manager may begin to take decisions which are oriented by his personal ambitions. So he may take decisions which do not follow that wealth maximization principle. There are lots of decisions which he can take. So the other aspect is he may take very conservative decisions. You know, see, a manager wants his job. The CEO wants to remain CEO. To remain CEO, he may want that the company should stay with very risk-free projects. Why should I take high risks? Why take a nano type of decision? Even simple stuff. I'll get a lower return, but at least my company will get a profit. If I continue to get a profit, I will get my salary, I'll get my bonus, I'll get my perquisites. So there, but the shareholder may say that why are you being so conservative? There are opportunities there in the market. Take advantage. Why are we getting such a low profit? Why can't you increase the profit? So you see, there can be a slight conflict of interest between the manager and the owner. Are you getting this, Anjali? Harsha?
Yes, sir. Yes, sir.
Okay. Now, so managers may simply go for survival. They want the company to survive. So it may be a company which is not performing excellently well, but it is performing. And since it is performing, even if the market value of the company is going down, the manager will still get his salary. So there is a certain problem here, and this problem is known as the agency problem. Now just imagine if there was no agent, if there was no manager. In the old days, or even today in the case of small private companies, the persons who invest in the company, the persons who are the majority shareholders, those are the persons who take all the financial decisions. One of them is the chairman of the company and managing director. So there is no conflict. They do exactly what they want to do. Whatever is their actual desire, they do that. But the moment you bring in a management begins to take decisions which may not be in accordance with your own desires. The owners may want something else. The objectives of the owners may be different. But the manager will take different decisions because remember, in the final analysis, the decision is made by the management of the company. The owners don't make the decision. So when we look at that, we come to this point of agency cost. What is the cost which happens? I have got an agent to run my company for me. What is the cost? So one cost is the management decisions result in a decline in share prices. What is the cost? My wealth is reduced. I chose an agent. The agent didn't do what I wanted him to do. He chose to run the company very conservatively. The market did not appreciate that. The market value actually went down. One of the costs I have borne by having this particular agent is I have actually lost wealth. Point clear? Okay. Then monitoring and controlling management also has a cost. Because when you want to control someone, how will you control him? Carrot or stick? No? Either you give him more money, you give him a bonus, give him something which he appreciates. That can be one way of controlling him. So I'm saying that, look, do as I expect you to do, I will pay you extra for it. So that's maybe one way of doing it. So another way is make the manager a owner. How do you do this? You give him a stock option. you give him shares in the company. So you people have heard of this, na? This employee stock option.
Yes. Yes.
Most companies today, private companies today, will give a certain number of shares based on the performance of their employees. So every year, a certain number of shares is given to the employee. What is the idea behind this? A person who gets 1,000 shares in his own company knows that if I perform well, then the performance is good. Market also sees the performance as good. More people demand my shares. The share price goes up. I gain directly because I have 1,000 shares. Today the value is 100. If tomorrow the value goes up to 150, I have increased my wealth by 50%. So one way of giving an incentive is to make them owners. Bonuses can be offered. You tell the management, look, you get me a profit of 500 crores at least. If you get 500 crores, we'll give you a bonus of 1 crore. We'll give you a bonus of 5 crores. So something which makes it sweet for them to actually do that. So what will the management do? They will try to take decisions, even if it involves a little risk, so that they can meet that profit target. And if they can meet that target, they will be able to get a bonus. So this is another way of controlling the management. This is one way. Now, we come to a different concept. So we come to this concept of stakeholder theory. So we say that anybody who has any dealing with the company, either financial or otherwise, is actually a stakeholder in the company. So normally when you say stakeholder, in your mind, you're thinking of the shareholder. Stakeholder, shareholder. But are there other people in the company who have a stake in the company? Okay?
Sir, employees are also stakeholders when they are issued ESOP.
Employees are stakeholders. Can you think of another stakeholder, Anjali or Harsh? So the any other stakeholders?
The competitors of the entity?
No, not the competitor. Competitor is not a stakeholder in the company. Who is a person who will lose something or gain something from this company? Employee is one, owner is two. Think of the people who have business dealings with the company, the people who buy from the company, the people who sell to the company. Suppliers and buyers, customers, they also have a stake. Na?
Yes.
They are also there. Then think of the one more very important, think of my old profession.
Finance.
Bank.
Finance.
Yes. So the banker has a stake. Na? The banker has a very obvious stake because if the company does not perform well, the banker will not get his money back. Similarly, we told you that many people sell goods to the company on credit. Raw materials may be sold to the company on credit. So these people who sell to the company on credit, they also have a stake. So many people, because if the company fails, they will not get their money back. So there are many people who have a stake. Now the government has a stake in the company. How? Company performs well, the government gets taxes. That is there. And finally, society also has a stake. Can you think of how society has a stake? How does society have a stake? Let's say that there is a factory which is making chemicals in your town. Now, do you have a stake? Okay, let me make this give you a even more loaded example. There is a nuclear power plant 10 kilometers away from your town. It is producing nuclear power. It's a company. It's producing nuclear power. What is the stake that your town or that society there has in that nuclear power plant? Or do you have any stake at all?
The nuclear power plant will harm the society and the surroundings.
Okay. It can harm the society and surroundings
As
if there is a let's say leakage of radioactive materials. If that happens, people can actually be hurt. A chemical factory,
once again, it will produce pollution. It will pollute the environment.
it will pollute the environment,
Release
pollutants. So it will release pollutants into the environment. It is bad for the soil in that area. It is something which society is definitely concerned about. So society also has a stake. This is a negative side. Can you think of positive contributions where society has a stake?
Employment generation in the
Yes.
organization.
Yes, perfect. Very good.
And
So,
also a special economic zone where there is huge industries. For example, in Jamshedpur, that the area is called special economic zone. So it's positive impact.
that's a positive thing. So this particular, there are lots and lots of stakeholders, and these stakeholders all matter. All of them have a stake. So the stakeholder theory says that the management is not just responsible to the owners of the company. The management should not be working only in the interest of the owners of the company. Management has to work in the interest of all stakeholders, looking at the long-term view. Because if I only think of making money, then at some point of time, I will be taking actions which will result in problems at one level or the other. So internal stakeholders are shareholders and employees. They are internal. External shareholders, creditors, suppliers, consumers, government, society, like we discussed. Manager cannot ignore them. All stakeholders monitor the performance of the manager. Remember this. Everyone is looking at the company, how well it performs. The employees are interested because their future depends on it. The shareholders obviously are interested because the return they get depends on it. The creditors, suppliers, all of them are interested because if that company does good business, they are able to also get a return from that. The creditor gets his money back, the supplier continues to find a good buyer for his products, consumers get a good product, government gets more taxes. So everybody is looking at the way the company is performing. Public limited companies will be publishing their results every quarter. So all the stakeholders actually look at the results to see whether how well that company is actually doing. And most of them have some leverage. Leverage means the ability to force you to do something. So most of them have leverage. Employees can impact performance. See, what is the leverage an employee has? If employees decide not to work properly, the quality of your products are going to suffer. The quantity produced will suffer. Suppose they go on a work to rule concept. I'm only going to work from 10 to 5. I will not do anything extra. I'll only do what you ask me to do. Work to rule. What will happen? Your products your entire performance is going to be really bad. A deadline comes. Somebody comes and you get a huge order, but they say you have to give me this in 15 days. You need to, really get excellent performance out of your employees to produce that much of finished goods to meet your order. They decide not to cooperate. So they remind you that, look, when we come to you for higher salaries, we ask for bonuses, you guys don't cooperate at all. So today it's our time. We won't cooperate in meeting the thing. You can decide how you'll meet your order. So, people have actual ways of hitting back at you. And if the employees have a trade union, if they are unionized, there is a provision whereby a representative of the employees, the trade union leader, whoever he is, that person will have a seat on the board of directors. He is actually a trade union director. He'll be sitting in that meeting. And in that meeting, he will be asking questions of the CEO. He can actually ask, why did you take this decision? Why did you take that decision? It's going to be very embarrassing for the CEO. So people, different stakeholders have leverage. The government can, what is the leverage the government has? Let's say you're polluting the environment. The government can come down on you, and take you to task for doing that. Your quality goes down. What is the leverage consumers have? They can stop buying your goods. They can say that, no, we will shift to some other supplier, somebody else, some other producer of the same goods who produces better stuff. Why should I buy from you? So you don't think that apart from the owners of the company, other people do not have leverage. Everybody has some way of hitting back at you. Now, we'll continue with these other stakeholders. See, creditors can apply pressure. Banks can definitely apply pressure on you if you begin to not repay. If you're not repaying, bankers are going to actually hit back at you. That's another thing. Consumers. So, and the best part or the most complicated part is that the interests of these different groups may actually clash with each other. This is the big problem. The interests of these groups may actually clash with each other. So the shareholders may just want the company to go for maximum profit. But the employees or even the management may want not to go for profit, but to go for growth. Let us go for more sales. To increase sales, I actually reduce profit. So no, there can be conflicts of interest. Management may want that the employees work harder. Employees may want more benefits. There can be different contradictions in the interests of these different stakeholders. In the long run, the shareholder wealth maximization may be achieved only when the interests of all stakeholders are taken into account. This theory is known as the stakeholder theory. The stakeholder theory basically is saying that if a company is to prosper, if a company is to really do well, it is necessary for that company to look after the interests of all the stakeholders that are here. Everyone? Lokesh?
Yes, sir.
Okay. So managers have to reconcile the conflicting interests of different stakeholders. This is the tough job that they have. So when they take decisions, they have to take into account what these different stakeholders desire. Consumers want excellent quality. For excellent quality, I need to appoint quality inspectors. If I appoint quality inspectors, then I need to incur more costs. If I incur more costs, I end up with a lower profit. There is a very clear trade-off here. What do you want? Do you want your consumers? Do you want higher profit? So, workers may want some necessary welfare schemes for themselves. Canteen, parking, leaves when needed, etc. But majority shareholders may focus on profits only. So the management has this tough choice, choices in front of them. How do I run the company in a way which manages to satisfy everyone? So it's a very, very tricky thing. And this is why when you first think about it, it appears that wealth maximization is the only objective. But is it the only objective? Can it be the only objective? Running the company in a way which is sustainable. That is the objective. You want your company to grow. You want your company to be there for years to come. To do that, you have to take everybody along. If you take a very short run, a short-term view, and you say that I just want to milk this company and make any amount of profit, then what will happen is after some time, you're going to run into trouble. One of the best examples here, recent company, a bank which failed, was Yes Bank. Harsha, you might remember this.
Yes, bank, yes. Bank.
Yes Bank. What happened with Yes Bank? They wanted to become the best bank, make excellent profits in a very short term. To do that, the CEO of Yes Bank was who? Remember the fellow? Rana Kapoor.
Rana Kapoor.
So Rana Kapoor decided to give money to corporates, which turned out to be very risky. And he was willing to take this risk. Why? Because if you give more and more loans,
You can,
you can tell your shareholders that look at the growth, look how much loans I made. And I'm giving it to good to companies. These are good companies. And they're going to make me a lot of money. I'm going to earn a lot of interest. And then one fine day, those companies, they don't do so well. The projects they had invested in, they were already risky. They are not making so much money. They are unable to pay you. Your loans go bad. And then what happens? A day comes when the RBI steps in. Rana Kapoor is not given an extension, and the whole bank has to be bailed out by LIC and SBI. So the thing here is that it is a very, very tricky area, this whole thing. And you have to be very clear about not being adventurous. You have to take into account all stakeholders. See, who are the stakeholders in a bank? One of the biggest stakeholders are the depositors, the people who gave the money to the bank to make loans. If you are irresponsible and you give bad loans, you are not taking into account your depositors. And it is the depositors who made it possible for you to do business. And the moment you do that, a day comes when people will begin to desert you. People will keep withdrawing money from you. People will not go to you. Do you think Yes Bank has not had any impact on this? This has not had any impact on Yes Bank. Even today, people are going to think once before they go and deposit money in Yes Bank. This is a bank which allowed its CEO to take decisions which were not in the favor of all stakeholders. So this is something which is, like wealth maximization cannot be the only way to run a company in the long run. If you begin to think only in terms of short-term profits, some disaster may just happen. So this is one aspect. We look at other critical conflicts. So look at this one. Here is another very classic conflict. This I'm giving you something in the future. But ultimately it is again a conflict of interest, another huge problem for the management of the company. So one way of reducing cost is go for robots, go for artificial intelligence. What will happen if you do this? Suppose you go
Employment.
Yes.
Employment.
So you replace humans with robots, with artificial intelligence. What happens is, in the process, thousands of jobs are lost. Okay. Now it is estimated, this is from a report in McKinsey, it is estimated that in the Western world, up to 47% of jobs may be lost due to artificial intelligence in the years ahead. 47%. One example, so is driverless trucks. See, in the US, trucks which run without drivers.
Tesla,
automated trucks. Now, Tesla is a car, na Lokesh? This is a truck.
Okay.
They have now come out with driverless trucks. And in one state in the US, Texas, they have actually allowed these trucks to run. They're saying you can test these trucks on the road, and then you can use these trucks. What will happen? All those drivers will lose their jobs. So the company which is there, this management has this decision. Owner will say, go for automated trucks because we can use them, even more, and they are very safe. Number of accidents will go down. We won't have to pay overtime. Everything is going to go well. Drivers get tired. Machine doesn't get tired. But if the guy does that, what does he do? He ends up hitting the jobs of the thousands of truck drivers who are already there. So, there are very clear conflicts of interest which happen. Another example, robots are already being used to make cars. You've seen, WhatsApp videos, and you've seen other videos where you see robots are making cars. Now, those robots which are making cars, they are making it at the cost of the
Human jobs.
yes, human jobs. People who are there making it, they have lost their jobs. The robot will make the car, and the robot will do it better. The robot will not make mistakes. As a result of that, quality will be maintained, and the temptation will be in the going forward, let us continue to use robots. Why have humans at all? In the process, what is happening is wealth may be maximized for the owner or for a small group of people. Everybody else is losing. Ultimately, what will happen? Ultimately, you may find that government will step in. That no, this cannot be done. We cannot have something like this. This is a bad use of technology. So this is leading to social unrest. In the process, the company may have to close down. I'm just giving you a simple black and white scenario where I'm saying that conflicts of interests can occur. It is for the management to take wise decisions. And if the management is unable to run the company in the interests of everyone concerned, all the stakeholders, it can result in a situation where in the future, the company itself does not survive. Okay? So, going forward, when we think of shareholder maximization, please remember it cannot be an objective. It is the basis on which you are making a decision. So it's called a decision criteria. Criteria is what? Is one of the reasons for making a decision. So the reason for making a decision may be wealth maximization, but the objective is different. Wealth maximization is actually not an objective. The objective will be in the mission of the company. So, the company may have something be like Amazon mission be read. If you want to be a place, an online marketplace. That is the objective. Wealth maximization is basically guiding your basic decisions, but the objective may be different. So it's laid out, the objectives of the firm is laid out in their mission statement. Strategy is designed around the objectives and defines the market, products, and technology. Based on the objectives, you make the strategy. We discussed that in the previous unit. And support the strategy, the firm lays down policies in production, marketing, purchase, technology, finance, etc. First step in the corporate decision-making process is to see that it is consistent with strategy. Whatever strategy you've made, the CEO will try to take decisions in according with the strategy, because the strategy is made to meet the basic objective of the company. The basic objective of the company will be to deliver some service, produce some goods, something like that. Now, the second step is to ensure that the results, whatever decisions he takes, it results in shareholder wealth maximization. So the objective is whatever the company has, whatever goal it has, that is the objective. But while taking decisions to achieve that, the CEO has to think, how can I also, do my job in such a way that wealth is maximized? And remember, when we say wealth is maximized, we are looking at wealth in the long term. We are not thinking of some short-term decision which is taken only for the let's say, the benefit of getting a short-term return. That is not the point. The point is, I take decisions which allow this company to exist over a long period of time. And every decision I take, it meets a minimum standard of economic performance. So let's say that at least an 8% return or a 10% return is considered to be okay. Then whatever decision I take, that course of action which I spoke about in the beginning, that should be able to get me that return. But my decision should be such that while they look after wealth maximization, they also take into account the let's say, the interests of my different stakeholders. So are you getting all this?
Yes.
So see, wealth maximization, therefore, is not something which you will simply assume is obvious. It is not an easy thing. Because wealth maximization has to be thought of in a sustainable way. It has to be something which I can continue doing. So the management is not only an agent of the shareholders, but a trustee of the other stakeholders. See, a trustee is what? Somebody who keeps something in trust for you. Somebody who is willing to protect something so that your interests are not harmed. So the management is like that. The management is expected to keep the company running in a way so that the interests of other stakeholders are also taken into account. So he has to harmonize the interests of owners with other stakeholders. So it's a fine balance which is required here. And remember, in the final analysis, this is the point I was making earlier. The decisions are taken as per judgment of management. No matter what the owners want. Ultimately, they have given the power to the management to act as their agents. So the agent will take a decision as per his judgment. Okay, and so that actually brings us to the end of the wealth maximization part. So the last slide which I have is called profit maximization. Why I did this was, quite often if you, suppose you want to Google the word wealth maximization, you will find that it will always be compared with profit maximization. So what I want you to understand is, profit maximization is a short-term thing. What is profit maximization? The process of increasing the profit earning capability of the company is referred to as profit maximization. It is mainly a short-term goal and is primarily restricted to the accounting analysis of the financial year. So I will try to make my results, quarterly results, appear to be good. I will make adjustments. Lokesh is in the chartered accountant business. He understands this sentence better, right?
Yes, sir.
You know what I'm saying? So
Yes, sir.
you can do things to give it an appearance of success. And do things in a way where it looks very good. That is profit maximization. It is primarily concerned as to how the company will survive and grow in the existing, this partner in the existing competitive environment. There is huge pressure on me. I want my stock prices to go up. So I'll do anything I can, including some accounting jugglery, to make sure that my profits show very high figures. And I'm able to somehow convince the market that, look, I'm doing very well, as a result of which my market prices go up, and as a result of which wealth appears to be maximized. So it's a short-term thing. You can't keep on doing this quarter after quarter after quarter. At some point of time, reality will catch up with you And if you're not really performing very well, it will reflect in your results. So basically, this brings us to the end of this subsection, which we were doing in Unit 2, Wealth Maximization. Think about this, have a look at the slides. If you have any questions on this, anything at all, then we will discuss this tomorrow. Tomorrow, I'll continue with the same other parts of this unit, which are about corporate social governance, triple bottom line, that sort of thing. All those things will fit in very nicely with the stakeholder theory that we were speaking. So have a look at this. If you get the time, tomorrow is a Sunday, take some time, 15-20 minutes, look at your notes. This I'll be sending to you tomorrow or day after this presentation. And just think about this, what we discussed today. Anything which occurs to you, any thoughts which you have in mind, we can discuss tomorrow. Okay? Okay then. Good night.
Thank you, sir.
Good night, sir.
Okay then. Hope that was, you guys enjoyed that.
Ah,
It wasn't
sir.
too boring.
No, sir. Not boring. Okay. Bye.
Bye.